Welcome back to the BD Daily Finance News Podcast, daily insights on markets, the economy, and investing. I'm your host, and this is the Beyond Daily Finance Show for December 10th, 2025.
And I'm your guest. Today is Fed Day, silver is acting like a meme stock, and crypto is basically pre-gaming for volatility. So yes, your portfolio is doing cardio.
Here's the lineup. Story 1, the Federal Reserve's big meeting and why bond traders don't completely buy the extended rate cut fairy tale. Story 2, silver making a run around $60 an ounce and whether this hot trade still has juice. Story 3, Chinese inflation surprising to the upside and what that means for stocks, the dollar, and even your crypto.
Translation, we're answering 3 questions. Is the Fed about to save your mortgage? Is silver the new Bitcoin? And is China about to make everything more expensive again, including your takeout dumplings?
Let's start with the Fed, because that's the gravitational center of everything else today. Markets are widely expecting the Fed to deliver another 25 basis point interest rate cut while updating the famous dot plot that shows where officials think rates could go over the next couple of years. At the same time, bond traders are already betting that cuts after this year might be shallower than what earlier Fed projections suggested.
So the Fed is like, we'll cut rates gently, like a careful barber. And bond traders are like, no, you're using the discount clippers and you're stopping halfway. Who do we trust here?
Think of it this way. The Fed's official forecast, the dot plot, is like the diet plan on your fridge. Bond traders are the scale under your bed. The plan might say several more nice, steady cuts over time, but traders are looking at inflation still above 2% and a labor market that hasn't totally cracked and saying, you're not losing that much weight that fast.
And a lot of previews are calling this kind of move a, quote, safety cut, right? Like they're trimming a bit because recession signals are flashing, but inflation isn't fully back at target. So the Fed is flying with half the dashboard still blinking.
Exactly. The data is messy. Some indicators say slowdown, others say inflation is sticky. Going into this meeting, there's a bit of a data void, so the Fed has to lean on its best guess about where growth and inflation are heading. The real drama is how many cuts they signal for the next couple of years and how steep that path looks compared with what bond traders are pricing.
Okay, simple version. For normal humans, what does a, quote, shallower path of cuts actually mean? Like, do I refinance my mortgage or just stare sadly at my rate and eat ramen?
Finance in plain English. If the Fed cuts less and slower than markets hoped, long-term yields, like 10-year treasuries, can stay higher. That means higher mortgage rates, higher car loan rates, and potentially lower stock valuations, especially for growth and tech. If they surprise dovish, you get the opposite, cheaper borrowing and a tailwind for risk assets.
So if you're sitting on a variable rate credit card or an adjustable rate mortgage, you want the Fed to be like that friend who keeps picking up the check. And bond traders are saying, nah, that friend is about to start splitting the bill again.
Right. And there's another layer. When Treasury yields creep higher into a Fed meeting, it often means traders expect a more hawkish tone, or at least fewer future cuts than the market was dreaming about a month ago.
So, practical checklist. 1. If you've been thinking about refinancing, this meeting matters for your rate quotes. 2. If your portfolio is heavy on long-duration stuff like growth stocks, REITs, or long bonds, today's dot plot can decide whether they get a nice little Santa rally or a reality check.
And 3, the US dollar. If the dots and Powell's tone point to more cuts down the road than traders expect, the dollar could weaken. If they hint at fewer cuts, the dollar could strengthen. That ripples into everything from imported goods prices to emerging market stocks and, yes, crypto.
So the Fed is basically the main character, and my credit card, my 401k, and my crypto wallet are all side characters waiting to see if this turns into a rom-com or a horror movie.
Exactly. And speaking of drama, let's talk about silver, because that chart has more plot twists than your favorite streaming show. Silver has made a powerful run toward the $60 an ounce area, with prices pushing into territory traders haven't seen in a long time. Some strategists are calling this a make-or-break moment for one of 2025's hottest trades.
Silver is that quiet kid in class who suddenly shows up ripped after summer break. Gold's like, I'm the safe haven. And silver's like, actually, I'm up more than you this year. Sit down.
One big driver is industrial demand tied to things like data centers, electrification, and solar. Silver is both a precious metal and an industrial metal, so it can benefit from safe haven flows and from tech and green energy spending at the same time.
So financially, silver is like if your emergency savings account also had a side hustle in EVs and solar farms. It's not just shiny jewelry, it's wiring your future robot overlords.
Traders are watching this $60 zone as a kind of stress test. After such a steep run, if silver can hold up here, momentum players might pile in. If it rolls over, we could see a sharp correction as leveraged positions unwind.
Let's do the simple version. If I'm a normal person who just heard silver is near highs, is this a buy, a don't touch, or a please put the phone down and walk away situation?
Analogy time. Buying into a commodity after a big spike is like joining a party at 1 a.m. The music is great, but the odds of someone turning on the lights soon are high. If silver fits a long-term thesis for you, like believing in electrification demand, you size it modestly and expect big swings.
So not financial advice, but emotional advice. Do not YOLO your emergency fund into silver because you saw a shiny chart on social media. If you can't handle a 20% drop without texting your group chat in all caps, maybe keep it small.
And remember, silver doesn't move in a vacuum. If the Fed sounds more hawkish and yields jump, that can pressure precious metals. If they sound dovish and the dollar weakens, silver and gold can both get another leg up.
So the Fed is not only deciding my mortgage, it's also deciding whether silver keeps cosplaying as a tech stock. Love that for them.
Speaking of inflation and commodities, let's zoom out to China, because their latest numbers are on traders' radar too. Recent data show Chinese consumer prices ticking higher again. Combined with caution ahead of the Fed decision, that has investors on edge. Moves in Asian and European stocks, the yen, and metals are all being read through this macro lens.
So China's prices are heating up again, and everyone else is like, cool, we just finished one inflation era, let's not start the sequel. How does China's inflation actually hit regular people outside China?
Think of China as the world's factory. If factory gate prices and consumer prices there rise, the stuff you import, from electronics to clothes, can get more expensive over time. It also affects commodity demand. Higher inflation can make China's central bank more cautious about big stimulus, which in turn shapes global growth expectations.
So it's like if your favorite cheap restaurant suddenly has higher rent and food costs. They either raise prices, shrink portions, or cut staff. None of those are fun for you, the customer, or for workers.
And while traditional markets are in wait-and-see mode, crypto is doing its usual energy drink routine. Bitcoin and Ether have been sensitive to every hint about Fed cuts and the dollar's direction.
And while stocks are nervously sipping coffee, crypto is doing energy drinks. Traders are basically waiting for Powell to talk so they know whether we're getting a pump, a dump, or both in the same hour.
The logic is simple. If the Fed hints at more cuts and a weaker dollar, that's usually supportive for crypto and other risk assets. If they lean more hawkish, you can see a fast reversal. Options traders often position for big swings in BTC and ETH around these announcements.
So if you're in crypto, today is not the day to forget your risk controls and go on a hike. This is like leaving your toddler alone with paint. You might come back to something very different from what you left.
Let's connect the dots. Fed uncertainty, higher Chinese inflation, and surging silver all point to one theme. We are not in a clean, low-inflation, low-rate world yet. There's still tension between inflation risk and growth risk, and markets are going to swing on every new data point.
So for regular people, that means two things. One, don't build your whole financial plan on the idea that rates are definitely going way down and staying there. Two, don't chase every shiny trade, whether it's silver near 60 or some altcoin pumping on Fed memes.
Actionable takeaways before we wrap. First, if you have big borrowing decisions like refinancing or taking out a major loan, watch the Fed's statement and Powell's Q&A. The direction of long-term yields after this meeting matters more than the single 25 basis point move.
Second, if you're tempted by silver or other hot trades, ask yourself, is this part of a long-term strategy, or am I just FOMOing because I saw a vertical line on a chart? If it's FOMO, maybe sleep on it. The market will still be there tomorrow.
Third, for investors in global stocks or crypto, pay attention to the combination of U.S. policy and Chinese data. When the world's biggest central bank and the world's factory are both in flux, diversification and risk management matter more than ever.
And finally, sanity tip. In weeks like this, it's okay to do less, not more. Rebalance, tighten your risk, maybe set some alerts, and then go touch grass instead of refreshing your portfolio every 30 seconds.
You've been listening to the BD Daily Finance News Podcast, the Beyond Daily Finance Show. If today helped you make sense of the Fed, silver, or global inflation, hit follow and share this episode with someone who needs a calmer take on wild markets.
And drop your biggest money question from this week in the comments. We might roast it gently and answer it on a future episode. Until next time, may your rates drift lower and your stress stay hedged.